Hello everyone. By now, you must have noticed the gold rally across the world. In the last 1 year, gold returns have beaten all the major share market indices of all major economies of the world. Have you missed the opportunity and are now unsure to take part in this rally? Do not worry, you are not alone. In this video, I'll share the details of the past rallies in gold and also share the major factors which could push the prices further up and also those which could pull them down. So let's get started. Before moving on, please read the entire disclaimer carefully. So this table shows the returns of gold over the last 1 year. In last 1 week itself, the gold has returned almost 3%. In last 1 month, it has given returns of almost 9%. In last 3 months, it has given almost 8% returns. In last 6 months, it has given 22% returns. And since 1st January 2025 till date, it has given 39% returns. And in last 12 months, it has given more than 45% returns, which can beat any major economy of the world. It's tremendous returns from gold in last 1 year. Let's see the major tailwinds. So the major tailwinds are the factors which could push the gold prices further up. First is the geopolitical and economic uncertainty. This is arguably the biggest driver. Gold's status as a safe haven asset means that it tends to perform well during times of global instability, whether from international conflicts, political risks, or economic uncertainty. And at the current time, all these three are at play. Next is the central bank buying. So, central banks around the world have been buying gold at a historic pace. This is a strategic move to diversify their reserves away from the US dollar, which is seen as a long term structural support for gold prices. Third is the anticipated interest rate cuts. When the US Federal Reserve and other central banks lower interest rates, it reduces the opportunity cost of holding gold. Gold is a non yielding asset, so when returns from traditional income generating assets like bonds and saving accounts go down, gold becomes more attractive to investors. The market is currently expecting future rate cuts, which is a major tailwind. Next is the weakening US dollar. A weaker US dollar makes gold, which is priced in dollar, cheaper for buyers using the other currencies. This increases demand and pushes the prices up. The dollar has been trending lower this year, which has been a significant boost for gold. Next is the inflation concerns. Persistence inflation can erode the purchasing power of traditional currencies. Gold is seen as a hedge against inflation, and as long as there are concerns about rising prices, investors will turn to gold to protect their wealth. And the final factor is growing retail and ETF demand. There has been a notable increase in demand for physical gold, that is, bars and coins, and gold backed ETFs. This signals that both institutional and individual investors are looking to add gold to their portfolios as a form of insurance and a store of value. Now, let's see the major headwinds. Now, headwinds are the factors which could basically pull the gold prices down. So, first is the potential for hawkish monetary policy. If inflation proves to be more persistent than expected, central banks might delay or reverse their plan for interest rate cuts. A higher for longer interest rate environment would increase the opportunity cost of holding gold and could put downward pressure on its price. Next is the stronger than expected economic growth. A robust global economy and strong corporate earnings could lead investors to favor high risk, high return assets like stocks. If a risk on sentiment dominates the market, demand for safe havens like gold could wane. Next is the lack of significant volatility. While high volatility is a tailwind for a gold, a period of calm and stability in the financial markets and a de escalation of geopolitical tensions could reduce the demand for gold as a hedge. And last is the profit booking. Now, given the substantial rally in gold prices this year and in the last 1 year, as we have seen 45% in last 1 year, several investors may choose to book profits, which can lead to short term price corrections. Now, let's take a look at a graph and see the past rallies in gold. So, this graph shows the past rallies in gold, and as you can see, there are in the past there were two rallies, one which started in 1978 and goes on till 1980, so for 3 years, and during that time the gold has given returns of 330%. Okay, so uh, in 1978 uh, the gold has given breakout and it has created a all-time high, and for the next 3 years the prices of gold keeps on increasing till 1980, and from that point onwards till 2008, so 28 years, there was no all-time high for gold. In 2008 there was an all-time high. So from 2009 till 2011, again for 3 years, the gold has demonstrated another rally, and it has given returns of 120% in those 3 years. Now from 2011 till 2022, again there was no return from the gold as such. There was no all-time high. In 2023, the gold has started its upmove again, and a new rally has started, which is still going on. So in 2023, 24, and now it's 25 ongoing. The gold has given already given 90% of the returns. So 90% returns in again this 3 years. So now can gold prices can move further up? Yes, definitely it can. There are several tailwinds, and the major leaders of the world, it seems that they are hell bent to for the instability in the world. So yes, I think that's my personal opinion, of course, that still the gold has so much steam left, and it the prices could at least go 20, 30, 40% higher. But still, again, that is my understanding. That could be totally wrong as well. So again, so this is the third rally which is going on in the last 50, 60 odd years. This is the third rally which is at the moment ongoing. Now, if you believe that you should invest in gold, let me share the primary gold buying options in India. And let's see each of them and also their pros and cons. So, the first option is the physical gold. This is the most traditional way of investing in gold. It could either be gold jewelry or it could be gold coins and bars. Gold jewelry are widely purchased for cultural reasons, but not the most efficient investment. You incur significant making charges which are non recoverable upon sale, and there is a risk of purity issues unless it is BIS hallmarked product. For the gold coins and bars, it is a purer form of physical gold, typically with lower making charges compared to jewelry. They are available in various denominations from banks, jewelers, and certified sellers as well. You need to consider secure storage and insurance costs. Next option is the digital gold. This is a convenient way to buy and sell gold online without the hassle of physical storage. So, in this, you buy gold in small quantities, and an equivalent amount of physical gold is stored in a secure vault on your behalf. The pros for this is you can invest with very small amount, as low as say 50 rupees, 100 rupees even. Easy to buy and sell, and no storage concerns, and can be converted to physical gold. So it is a big pro for this type of option. But there are cons as well. It is not regulated by SEBI or RBI, and some platforms may charge a storage fees after a certain period. Maybe not upfront, but after some period of time, they may start asking for a storage fee. The third option is the gold exchange traded funds. Now, these are a type of mutual fund units that are backed by physical gold and are traded on stock exchanges. In this, you buy and sell sell units of a gold ETF, just like a share. One unit is generally equivalent to 1 gram of gold, but that is, of course, not always true. There are several pros of gold ETFs. They are highly liquid, they are transparent in price, no making charges or storage cost, and you can invest them with a demat account. Few cons include you need a demat and a trading account, and you have to have brokerage and a small fund management fees expense ratio. Okay, so there is a small payment involved in this. Next option is the gold mutual funds and gold saving schemes. Now, gold mutual funds uh, are the funds which primarily invest in gold ETFs. They are fund of fund schemes. Basically, the fund manager invests your money in a gold ETF. The pros are that you do not need a demat account, which makes them accessible to a wider range of investors. You can invest through a systematic investment plan as well. The con of global gold mutual fund is that generally they have a slightly higher expense ratio than the gold ETFs, as they also have to pay the expense ratio of the underlying ETF. And the fifth is the gold saving schemes. Now, the many jewelers offer these schemes where you can deposit a fixed amount every month and for a set period, and at the end of the term, you can buy gold for the accumulated amount. Now, it is a convenient way to save up for physical gold purchase, but these schemes are not regulated, and the returns can be lower than the market linked investments due to high making charges of the jewelry you eventually buy. Okay, so we have seen the tailwinds, the headwinds, the past rallies of the gold, the ongoing rally, where it stands, and we have also seen the primary gold buying options. So I guess that is all from my side in this video. Thanks for watching it, and if you have liked it, then share, comment, click the like, and subscribe to the channel. Thanks for watching this video. Goodbye.